Let's just dive right in. Welcome to This Explainer. Today we're going to unpack one of the most fundamental, yet honestly widely misunderstood mechanisms running our modern world. We're taking a look at the core engine of modern finance, fractional reserve banking. And okay, to make these massive, invisible economic forces a bit more tangible, we're actually using a macaroni noodle art style to visualize it. I know, it sounds kind of playful, but trust me, by the end of this explainer, you're going to understand exactly how the global economy builds its entire foundation.
So I want you to really think about this for a second. Where is your money right now? It's super easy to operate under this comforting, kind of old-fashioned illusion, right? We imagine that when we walk into a bank and hand over our hard-earned cash, a teller takes it, walks to the back room, and puts it in a little static cubby with our name on it, just sitting there, waiting for the day we come back to get it. But the truth is, that deposit, it doesn't sit still for a single second. Yeah, the static vault is a total myth. The reality is that commercial banks are dynamic, highly active money creation engines. They are absolutely not just storing your wealth in a safe. They are actively putting it to work the very second it leaves your hands. The crucial mechanic that actually makes this whole thing possible is called fractional reserve banking. Basically, it's a system where commercial banks are only required to hold a fraction of depositors' funds in liquid reserves, like actual vault cash or deposits sitting at the central bank. And the rest, well, they're permitted to lend the remainder out to borrowers. So rather than just vaulting your cash, banks actually expand what economists call the broad money supply, or M2, simply by generating credit. You can really see how this compounding credit expansion cycle plays out in reality. Cash enters the banking system and then expands exponentially. It's this continuous loop, right? Depositing, lending, spending, and redepositing. They aren't just shuffling your money around. This is literally the primary engine of commercial money creation in the modern economy. Think of the initial currency as a seed, and the fractional reserve system is the soil that lets it grow like wildfire. Okay, let's walk through how this builds in a real-world scenario. Let's assume a theoretical 10% reserve requirement. Say person A deposits a crisp $1,000 into Bank 1. Instantly, fractional reserve rules kick in. Bank 1 holds on to 10%, which is $100, and they loan out the remaining 90%, or $900, to person B so they can, let's say, go buy a car. The guy who sold the car then takes that $900 and deposits it into his bank, Bank 2. Bank 2 holds its 10%, $90, and loans out $810 to person C, and the cycle just keeps rinsing and repeating. It brilliantly illustrates the sheer, almost magical power of this chain reaction. Just from those first three steps, that initial $1,000 deposit of central bank cash has miraculously created $2,710 in total bank deposits across the economy, 1,000 plus 900 plus 810. The theoretical ceiling for this money expansion actually depends entirely on that reserve requirement ratio. So if it's 10%, the maximum expansion is 10 times the original amount. The bank is literally creating money out of thin air. Well, out of credit. It's wild. But this brings us to a very serious, very structural vulnerability. What if everyone wants their noodles back at once? See, banks are taking your deposits, which are essentially short-term liabilities that you can demand back literally anytime, and they're turning them into long-term assets like 30-year mortgages or multi-year corporate loans. Because of this mismatch, banks are inherently illiquid. There is absolutely no bank on earth that holds enough liquid cash to pay off all its depositors if everyone demands their money at the exact same time. Which means the entire fractional reserve system operates on just one very delicate psychological thread: public confidence. If that confidence breaks, you get a bank run. It usually starts with fear and rumors, Depositors suspect a bank is struggling, and panic ensues. Suddenly, everyone is trying to withdraw their funds before the liquid reserves run dry. This leads to mass deposit withdrawals, which rapidly drains the vault until the bank flat out runs out of liquid cash. Ultimately, this escalating panic turns a manageable, everyday situation into a total solvency and liquidity collapse. And hey, this isn't just theoretical. Panic at one institution can easily spread like a virus across the interbank lending network, threatening widespread systemic collapse. We call this systemic contagion. We saw it with Northern Rock in the UK back in 2007, and very recently with Silicon Valley Bank in 2023. When healthy banks face sudden, overwhelming liquidity demands driven by sheer panic, the entire financial structure can just begin to snap. Fortunately, modern economies have developed a pretty robust safety net to prevent this. To stop panic right at the source, we have deposit insurance, like the FDIC in the US, which guarantees everyday retail deposits up to a fixed threshold. That basically eliminates the incentive for everyday people to panic in the first place. But if a bank still faces pressure, central banks act as the lender of last resort. They step in to inject emergency liquidity to solvent banks facing temporary run pressures. And to make sure banks are resilient to begin with, strict regulatory capital requirements through frameworks like Basel III force them to hold high-quality liquid assets well beyond what they just keep at the central bank.
Now, here is a really fascinating modern policy twist. Get this: 0%. In March 2020, amidst all the global economic shifts happening at the time, the U.S. Federal Reserve actually reduced reserve requirement ratios to 0% for all depository institutions. Zero. They shifted their monetary policy execution away from strict reserve mandates and instead moved toward managing interest on reserve balances within an ample reserves regime. So the traditional constraint of the reserve requirement is, in some major economies, currently sitting at exactly zero.
So why do we do this? Why do we accept a system built on such inherent risk? Well, it all comes down to the grand trade-off. Fractional reserve banking is the essential engine that powers industrial economies. It takes idle capital, money that would just be sitting under a mattress or locked in a static vault somewhere, and mobilizes it. It turns it into productive loans, businesses, and infrastructure growth. It literally creates the modern world around us. But in exchange for that incredible growth, it introduces a systemic fragility that absolutely mandates central bank oversight and those heavy government safety nets we talked about. Which leaves us with this final thought. You've seen the illusion of the static vault, you've explored the incredible multiplying power of the lending engine, and you've seen the precarious structural risks that require constant government backstops. So knowing how this incredibly dynamic, occasionally fragile engine actually works behind the scenes, just how safe is your macaroni? It's a delicate balancing act of confidence, regulation, and growth that keeps our entire economic world turning every single day. Thanks for joining me on this explainer, and definitely keep asking the big questions.